Welcome back. It's time for another check-in with our friend Mike Eppel over at 680. And Mike, this time you're talking about consumer debt. It is piling up.
Yeah, some numbers just in this morning from Equifax Canada, a tabulation of all of the money that we as a country owe on the consumer level. And it is now at $1.7 trillion with a T dollars. Now that includes mortgage debt, auto loans, credit card debts. So it's a complete collection of everything that is owed on the red ink side of the ledger. What's interesting about the numbers, actually, Melanie, is that last year, almost half of Canadian consumers were reducing their debt. So that's good. The problem is the 37% of Canadian consumers that were increasing their debt were actually increasing debts more than what was being taken away from those who were paying down what they owed. And then you look at it on a regional basis, more debts being taken on here in Ontario, and a lot of that can probably be tied into the mortgage market, people taking out larger mortgages because the price to buy a property in the GTA is so high right now, and debt delinquencies still being affected because of the oil market downturn. So the highest problem there would be in Alberta, Saskatchewan, and Newfoundland and Labrador. And the age category for most debt acquired last year, seniors. So that's also a troubling sign, because when you're seniors, you're supposed to be paying down what you owe. But again, trying to pay those bills gets more expensive by the day. And U.S. interest rates in the U.S. expected to go up today as the American Central Bank is widely anticipated to raise its benchmark by 0.25%. It's a sign of economic confidence on the U.S. And the Fed might be raising rates a couple more times after this year. So we'll track all this and the effect it'll have on the Canadian dollar, because our Bank of Canada has said, yeah, they're not raising interest rates here anytime soon. We've still got some struggles in our Canadian economy to deal with. So Canadian dollar has been down recently. This morning, steady. Price for oil after a 7-day slide also showing a little bit of resiliency and popping a bit higher. We'll also be tracking the auto sector today, because U.S. President Donald Trump will be in Detroit, and he's expected to announce plans to lower the fuel efficiency requirements on the Detroit 3 automakers, U.S. car makers in general, sort of rolling back some of the EPA regulations imposed by the Obama administration, looking to make it a little bit easier for the Detroit 3 specifically to build larger cars and trucks, because that's what's in demand right now for the U.S. buyer specifically, as the price for gas has remained relatively inexpensive in the U.S. They want more big trucks, big SUVs. The automakers, though, have been forced to build more smaller cars just to balance out the fuel efficiency average among their entire fleet. Hudson's Bay Company also in the spotlight today, because there is talk the Bay is talking to the Canada Pension Plan about buying the CPP's ownership stake in U.S. luxury retailer Neiman Marcus. Problem is the Bay doesn't want all of the debt that's currently owing on Neiman Marcus to the tune of about $6 billion. So there's still lots of negotiation to go on there. There was also talk that a couple of weeks back that the HBC was looking at buying out Macy's, but nothing has come of that, at least not yet. And coming up later today, after the close of trade, we'll have the pricing on shares of Canada Goose. It'll be listed at the Toronto and New York Stock Exchanges, expected to raise a couple of $100 million for owner Bain Capital. This is a stock that is expected to be in big demand officially tomorrow, because, and at the sale this afternoon, because it's been 3 years since a luxury retail brand has actually listed its stock on either market. So it's going to be very interesting to see where Canada Goose opens tomorrow, and does it fly high in the opening trades. $900 for a coat, but you're probably going to get the stock for about $20 a share.
Yeah, right. All right. Thank you very much, Mike.